Hello, everyone. Today I come to you again with an interesting story. If you have your coffee, let's start. The date is October 24th, 1929. Americans lost $18 billion in 12 hours. This amount is more than the value of the entire Canadian economy. Approximately 15 million shareholders panicked and sold. Telephone technology at the time could not handle this. Communication with the stock exchange was lost. Few people in America know that this storm started with the decision of a single person. A man whom newspapers and magazines called America's most popular banker, Sunshine Charlie. This was Charlie Mitchell. It was what sparked what we now call the Great Depression. 7 months ago, Charles Mitchell said something that would save the American economy from this bottleneck. Instead, it set in motion the mechanism of the most terrible collapse in human history. The Great Depression lasted 10 years and changed the lives of every American, even those unborn. 1 in 5 people, 25 million people, lost their jobs. 4,000 banks closed, taking the savings of millions of families with them. 2 million Americans were homeless. The situation of the families was very dire. He lived in cardboard boxes in tent cities called Hoovervilles. Suicides increased by 40%. Just yesterday, people were waiting in line to get free food in a country that defied everyone and considered itself the richest country in the world. So how did the world suddenly turn upside down? In the 1920s, America was experiencing an unprecedented boom. The noisy 1920s, Ford cars, radios in every home, jazz music clubs, skyscrapers rising one floor at a time. It was thought that prosperity and comfort would last forever with Americans. At that time, while millions were dreaming of wealth, a man who would turn life into a nightmare appeared on the scene. Charles Edwin Mitchell was born in Massachusetts in 1877. His family was a farmer. No one could have imagined that the son of this ordinary farming man would become America's most influential banker and turn the world of an entire nation upside down. In 1919, Mitchell became head of National City Bank, the nation's largest bank with $3 billion in assets. This was more than the budget of many countries in the world at the time. But the ambitious banker came up with a diabolical revolutionary idea. Before Mitchell, stocks were a toy played by rich men. Just 600,000 Americans, i.e. less than 1% of the population, owned stocks. Ordinary people had no knowledge, they just kept money in banks or bought bonds. The stock market was a club for the elite. However, Mitchell said this was wrong and every American should be a capitalist. Why should wealth be in the hands of only a handful of lucky people? In 1920, Mitchell formed a subsidiary company called the National City Company. Thanks to this company, he was able to sell shares to ordinary Americans directly from bank branches. When a person came to open an account to save money, he was offered to invest in the American dream. Mitchell was an artist at selling stocks. He was going over every detail. The psychology of sales, human greed, the dreams of ordinary Americans. He trained his sales staff precisely and placed them in 80 bank branches across the country. These were the staff trained to be the banks where customers came without getting bored. The advertising industry began to emerge during this period. Idea of placing an ad in newspapers. Become rich and realize your dreams by investing only $30 a month. They were very attractive ideas. Become a partner of American Telephone and Telegraph. Your children will be proud of you in the future. You are an investor. Magazines published success stories of unknown people. How did a secretary from Chicago become rich in 2 years? The blacksmith bought his own house with dividends. Specially trained salespeople used clever tricks. He said to the customers, "Mr. Jackson, you don't want to work for someone else all your life and make him rich, do you? General Electric stocks. Wouldn't you like to have a share of these shares, which have continuously increased in the last year and have earned their investors? This could be the turning point in your destiny. Or, Mrs. Houston, your husband works for Ford. Why don't you become a partner of the company? The offices of the National City Company were decorated with posters showing happy families against the background of large houses. Thanks to stocks, we bought the house of our dreams. Paintings of happy families, luxury items, smiling children. It's all about why, he shouted. But the real sharpness was in the credit plan. Shares could only be purchased on profit margin. Invest only 10% of your capital. Borrow the rest from the bank. Imagine you have $1,000. You buy $10,000 worth of stock. If they grow by 20%, you make $2,000. Double your money easily. Sellers illustrated this with a few puns. See, Mr. Jordan bought Port Corporation shares for $5,000, investing only $500. They grew by $1,500 in just 6 months. Profit 300%. And your money in the bank would only bring you $150. The result exceeded all his expectations. From 1925 to 1929, the volume of loans for stock purchases increased from $2 billion to $9 billion, an increase of 450% in 5 years. The number of Americans owning stock spread across the country, rising from 500,000 to 10 million. An engineer in Boston mortgaged his house in exchange for Port Corporation shares. A grocer in Detroit sold his store to buy General Motors papers. A teacher in Ohio invested 6 months' salary in Ford shares. Everyone believed this was their chance to get rich, and Mitchell was overjoyed that his plan had worked. He was nicknamed the monetary genius and democratizer of Wall Street. He earned $1.7 million in 1929. In today's money, that's $22 million. Newspapers wrote of him as the crazy man who made every American a potential millionaire. But Mitchell wasn't satisfied with these. Investment trusts that purchased shares with borrowed money created funds. These trusts became joint stock companies, whose shares were again purchased on credit. So what created this environment? It was like a glass tower built on the hope that prices would rise forever, waiting for an opportunity to break and fall. By 1929, even the economists who applauded this environment began to worry. Panic slowly began to set in. Stock prices were flying out of the economy like a rocket. The Federal Reserve System sounded the alarm. The market was overheated. The numbers had reached alarming levels. Shares of large companies were traded at prices 20 times their annual profits. By comparison, today such a rate is considered a sign of a speculative bubble. On February 6, 1929, the Federal Reserve issued a belated warning to banks. Stop giving loans that will lead to speculation in the stock market. The central bank demanded that margin loans remain within certain limits. The market's reaction was not late. As March arrived, stocks began to follow a downward curve. Within days, billions of Americans' dollars evaporated. Panic was growing. The bubble had burst. And on March 12, 1929, he received a decision from Charles Mitchell that would change the course of history. He held a press conference and made that much-anticipated historic speech, "No one needs to worry. National City Bank will provide the market with all the liquidity it needs. We will not allow a crisis environment to occur." This statement had an immediate impact on the markets. It appeared in the newspapers with huge headlines, "Sunshine Charlie is saving the market." This time, stocks started to move upwards slowly. The market recovered all its losses within a week and reached new records. After Mitchell's statement, the market was playing the final act of this madness. In the summer of 1929, stocks were breaking record after record. Dow Jones Index rose to 395 points. Well, a record that would be hard to break for the next 25 years. With the rise of markets and increased advertising, 3 million new Americans entered the market. Their wives were pawning the jewelry they had saved over the years to buy stocks. Shoe shiners and bakeries gave investment advice. Repairmen were just discussing among themselves which paper would be profitable. Even children were spending their pocket money on papers. Those who participated in this trend before had some experience and felt like geniuses. Simple clerks became millionaires on paper. Drivers bought multi-story houses. Secretaries, fur coats. Everyone was drunk with wealth and thought it would last forever. However, the reality of the disaster that would follow this comfort was hidden. Every dollar invested in stocks was backed by just 10 cents of real money. With a 10% price drop, the margin investor lost everything. With a 50% drop, they owed the bank more than they earned in a year. In the autumn of 1929, sane people began to become uneasy. Large financial institutions, pension funds, insurance companies, private banks saw warning signs that went unnoticed by ordinary citizens. In this environment, economic indicators were deteriorating. When everyone chose easy money, industrial production slowed down, car sales decreased, construction decreased, but stocks continued to increase, ignoring the facts. The gap between the stock market and the economy has become critical. Secondly, those who were sensible understood better than others what trading on credit meant. Knowing that the vast majority of money in the market came from borrowed funds, they saw that any decline would have catastrophic consequences. Joseph Kennedy, the future president's father, would later recount, "When the shoeshiner started giving me investment advice, I knew it was time to get out of the market." Third, insiders knew about the Federal Reserve System's plans. The central bank was preparing to raise interest rates, which would make margin loans more expensive and could trigger mass selling. The big players were quietly making profits. They stalled the market by playing little games to prevent it from crashing early. But by October, the games were sold out. Some banks received inside information that the Bank of England was planning to raise interest rates. In this case, it will automatically force the Fed to do the same. On the morning of October 25, 1929, New York's largest financial institutions made a joint decision with each other. It's time to exit. They started selling in large blocks. Sales worth billions of dollars. Hundreds of thousands of shares at the same time. Prices seemed to be falling off a cliff. At noon, panic began. They sold 12 million shares in one day, 6 times more than usual. Brokers kept orders waiting. Traffic was so high that people could not communicate with each other. The telephone system was down. The domino effect that Mitchell unknowingly created with his system was initiated. The first domino, falling prices, forced banks to demand additional contributions from margin investors. The second domino was that people did not have money for additional payments. If you bought shares, you are now a partner too. They were forced to sell their stocks, which drove prices even lower. The third domino hit was that stocks became unsuitable as collateral for new loans because their prices were in the ground. Banks stopped lending, money flow was cut off. Fourth, banks that had made too many loans began to go bankrupt. The first to fall were those who followed Mitchell's example. Black Tuesday, October 29th, the final collapse. Americans lost $15 billion in one day. That's more than the United States spent in the entire First World War. Of course, this table is only the financial part of the work. There is also the tragedy within its people. James Duran, a Texas mechanic, purchased Lord shares for $8,000, his life savings. By November, they were worth $300, and the bank demanded an additional $5,000. James hanged himself at work. Terry Field, a teacher in Detroit, mortgaged her family's home to purchase shares of the radio corporation. After the accident, the bank seized the house. A family of 3 generations found themselves on the street. In New York, queues formed not only at banks but also on bridges. People did not want to live with these debts. Suicides have reached record levels. The Brooklyn Bridge has become a symbol of despair. Those who were busy with wealth and expensive items just yesterday ended their lives today. What about Mitchell? He was summoned before Congress in 1933. Senator Carter Glass asked, "Do you consider yourself responsible for the destruction of millions of American families?" he asked. "I wanted to give people the opportunity to get rich," Mitchell responded. Nobody forced them to buy stocks. But justice caught up with Sunshine Charlie. In 1933, he was tried for $1 million in tax evasion. He was forced to resign in complete disgrace. The man who was called the savior of the market became the symbol of ambition and greed. American society was divided in terms of its attitude towards Mitchell. Newspapers that had previously praised him wrote differently about him. The New York Times called him the architect of financial disaster and the man who turned the American dream into a nightmare. Ordinary Americans hated him with all their heart. Protests took place in the streets of New York. A Detroit newspaper wrote, "Charles Mitchell stole more from us than any bank robber in history. One robber takes a bag of money, but Mitchell took the future of an entire generation." But there were also those who defended it. Of course, they were the ones who profited from this chaos. Many businessmen said Mitchell did not force anyone to buy stock. People chose to become rich suddenly instead of caution. Former colleagues claimed that Charlie was in the wrong place at the wrong time. Any banker in his position would have done the same. As for National City Bank, paradoxically, the bank not only survived the crisis, but also grew stronger. Following Mitchell's resignation, the new management stopped all risky operations, focusing on prudent deposits and loans. The bank received government support because it was too big to fail. Moreover, the collapse of rivals allowed National City to absorb its assets for pennies. By 1935, the bank controlled a much larger market segment than before the crisis. Mitchell spent the rest of his life in relative obscurity. After the trial, he moved to Europe and worked as a consultant for small banks. He returned to the United States in the 1940s and founded a modest investment company. Sunshine Charlie became an old man remembered only as a symbol of 1920s greed. Mitchell died in 1955 at the age of 78 and never accepted responsibility for the Great Depression. Confiscating gold allowed the money supply to increase and deflation to decrease, but the price violated Americans' fundamental right to own precious metals. The Americans delivered more than 3,600 tons of gold in 1 month. This is more than the current reserves of Russia and China combined. And a year later, the government raised the official price of gold from $20 to $35 per ounce, making billions of dollars from the confiscated metal. The scars of the Great Depression remained for generations. The American economy recovered for 10 years. Millions of people have lost their trust in the stock market forever. An entire generation preferred to keep money under their pillow rather than in custodial banks. Today, almost a century later, history repeats itself with frightening accuracy. 50 million Americans trade stocks via smartphones. The volume of margin loans reached a record $900 billion. Apps like Robinhood promise the same thing Mitchell does. Make everyone an investor. Zero commission. Trade like a pro. Invest your paycheck. He invests in next-generation cryptocurrencies and memecoin stocks. Borrowing from margin accounts. Same promises of easy money. Same cheap loans. It's the same mechanism that Mitchell created almost 100 years ago. Today, the average American owes more than he earns in a year. Margin trading has reached 1929 levels, and millions of people believe this time is different again. Charles Mitchell's story is about how good intentions can lead to disaster. He really wanted to give ordinary people a chance to get rich, but his system turned the American dream into a nightmare for a quarter of the country's population. Mitchell said in 1928 that every American should be a capitalist. They say everyone should invest today. History doesn't repeat itself, but it does rhyme. Next time you hear promises of easy money and calls to democratize finance, remember Sunshine Charlie and ask who will actually profit. There is no need to look far for what is happening today. If you look at history a little, you will find the answers you are looking for. I hope what I told you has awakened something in you. Follow me and subscribe to the channel for many stories in the field of history finance today. See you again.